Hey everyone, this is Matt Ryan with Revive. Very excited to have you here today to talk about one of the most exciting segments of the multifamily space, which is co-living. We're going to go over a very macro level as to the why behind co-living. I talk to investors a lot about this marketplace. It's still very much at its inception. A lot of people feel it's a little trendy. This is, something that's just here due to this affordability crisis and, some other, socioeconomic issues that are going on. I, for one, was a bit of a doubter when I first started digging into this and was brought this opportunity to us. But the more we've dug into it, and as you'll see as a result of the presentation materials, the more of a believer we honestly became and what a huge fan we are of this marketplace. So we're going to dig in very much into the why. What is the demographic drive behind co-living, and how our product then fits into this space and individually the markets that we'll be focusing on. So this presentation will run just a hair under 15 minutes, I believe. So if you feel free to take some time, coffee break, bathroom break, anything in between. Wanted to give you that preparation, but you won't want to miss out. Definitely watch it till the end, especially when we're talking about how we'll be using opportunities and capital gains to invest in co-living, in addition to some very specific elements about our product and our area of focus in co-living. So without further ado, we'll continue. First off, Revive's mission is to provide profitable investments for our stakeholders while improving the communities we serve. We're a social impact-based investment company, which means that we simply take a portion of the pre-tax profits of the asset management company, not the individual investments that we make, but the profits from the fees that we make from your projects, and invest that back into local nonprofits and affordable housing nonprofits to help bring up the communities that we're working in. Co-living very much fits into this thesis of community revitalization, innovating in the affordable housing sector, because from our perspective, we're catering to a renter by necessity class, providing rents below the market rate of a studio or below the market rate of a traditional single bedroom unit, and being able to do that, focusing on increasing the density of an existing product by anywhere between 150 to 200%. And so in review, okay, co-living, increasing density by up to 200%, okay, versus the existing use of a building or space, providing rents 15 to 20% below the market rate for a studio. What do we get in turn for that? In turn, we're getting anywhere between a 20 to 30% premium on net operating income. And in some instances, a 4 to 6% cash yield in a Bay Area product, which is typically unheard of. So I won't get too much further into the detail. You'll hopefully see this and we'll talk more about it. But the reason we're also excited about co-living is because we really believe it's an innovative product. It's catering to, like I said, that renter by necessity class, the people who really want to be in job centers, who really want all the amenities of walkable, bikeable, transit-oriented living, but who are struggling from a cost perspective. So, and it really kind of dovetails into this quote. I think when we look in the broader, and Peter Drucker was, who I'm a big fan of this quote and his work as well, is, as entrepreneurs, it's our job to respond to these things and not respond to them. I think so often we're seeing this in our world where we want to respond with public, policy and initiatives. And the truth of the matter is that, entrepreneurs are the one that drive this change. And we're the ones who see these opportunities. And I think exploits maybe somewhat of a negative connotation, because I don't think we're exploiting. I think we're delivering a very viable product in a lot of instances. And in this instance, to a market that already exists, which we'll talk about here a little bit later. But I really love this quote, and I just think it speaks to what we're trying to do here at Revive, and from a broader context, what we're trying to do with the co-living model. So let's focus this in on the urban cores, okay? Urban cores have seen explosive growth since the 2009-2010 recession. They've captured over 21% of household growth since then. This is through John Burns Consulting Group, which, if you're not familiar with John Burns' work, he's fascinating work and really does a very good job of statistical analysis of demographic shifts and how it relates to real estate. A lot of people believe that this trend is going to slow down. Okay. A lot of people feel like this urban renaissance kind of came and went, like boomers, millennials moving. We think it's going to continue to grow, maybe not at the exact pace or exponentially that it has in the last 5 to 10 years, but it's certainly going to continue on. And John Burns's analysis speaks to this, okay, in one of two ways. The trends that he thinks a lot of people are missing is, first off, a growth in racial and ethnic diversity is going to drive a lot of this demand, okay? The second one is delayed or non-marriage, which is a statistic that's really continued to grow, and we'll talk about why, in addition to higher educational attainment. And so that's where the majority of this new level of demand's going to continue to come from. And the reason why is the majority of the jobs are being delivered in urban cores right now. You've seen that kind of politically as well, right? Like everything feels like we're on these two different perspectives, these massive job growth areas and cities, and then kind of middle America, Southeast, right? There's a lot of political divide here. I won't speak to the politics of it, but the statistic remains is that our job cores are pumping out jobs at an insatiable rate. And we don't see this trend slowing down anytime soon. In particular, a few, which we'll cover here in a second. The other trend that's in play here, okay? A lot of people have talked about the millennials. It's time. Millennials are getting ready to not retire, right? But we're moving on, right? The next big talk of the town is going to be late stage millennials. That's the Generation Y, and the 45 million Gen Zs. 45 million Gen Zs and late stage millennials, they're going to hit the marketplace over the next decade, okay? It's time to start talking about them. And specifically when we're talking about co-living, which is kind of this hybrid student housing, hybrid, Craigslist model, if you will, this is who we're catering to, okay? So let's talk about that for a second. What problems are they going to face? Well, the issue that we found is that they're going to face a lot of the similar problems that millennials had to face, okay? And the first is that the typical rent payment in the US requires 29% of the national median income, okay? And most housing specialists deem that as rent burdened, okay? That means you cannot save enough money as what you just and pay your rent. Like you're either going to pay your rent, you have all your disposable income and not save, or you're going to save and have disposable income. You can't do both, right? And it's worse and accentuated in 14 of the largest cities, okay? Saving money for a down payment, simultaneously paying a high rent, mutually exclusive endeavor, right? So another big macro trend here, okay? From 2004 to 2015, student debt quintupled 5 times, okay? It's an average of $30,000 per student. So you're already paying a high rent. Now you come out with this student debt, this, big burden over your head as soon as you come out of college. It's a huge disruptor for people, okay? What does that cause? It's created these kind of domino effect, right? Family formation is delayed, okay? Another kind of unrelated trend, but one that contributes to family formation delay is the fact that women are now achieving 58% of all the college degrees, okay? There's more women in the workforce now than there is men, okay? What we've seen, average age of marriage has dropped from 5 years. Baby boomers are getting married around 22 to 23, to those born in 1980 to 27. So what has that done? It's caused a significant drop in the home ownership rate, okay? And that's not just family formation, getting married later, higher debt levels. Don't forget the cost of single family homes due to the cheap money being distributed at the Fed has also created a rise in asset prices, okay? 67% at its peak to 63 now. That's a significant drop. And John Burns is estimating that it's going to continue to drop. And I was a little bit skeptical of this, so I started digging a little bit deeper on this, because home ownership, as you guys know, is kind of this backbone of the U.S. economy, right? It's an integral piece of our economic growth. Well, bad news. Urban Institute, as well as the Harvard Joint Center for Housing Studies, that's JCHS, also predicting a significant drop in home ownership rates. Gen Z is very, very difficult to find data for, but we were able to come across this really cool graph from Property Shark that speaks to a lot of these trends. When surveyed, what was the number one obstacle to buying a home? Student debt and a down payment, okay? Same thing faced by the millennials, similar things faced Generation X. The trend is intact, okay? So we'll bring our focus back here to the Bay Area, okay? To date, the Bay Area has produced over 4 million jobs since the recession, okay? And that may not seem like a lot to some people, but take into consideration, it's over 400,000 more than it did in the prior peak and the dot-com boom in December 2000, okay? During the first 2 months of 2019, you know, we've heard the Bay Area, people are leaving in droves, everyone's going to Portland, everyone's going to you know, Austin, Texas, and that very well may be true. Those are great markets, don't get me wrong, okay? But for the first 2 months of 2019, the Bay Area accounted for 81% of all the job growth in California. So if anyone thinks that we're slowing down, you're crazy. It's not gonna slow down. We're gonna continue to pump out jobs day in and day out, okay? What is getting pushed out to Portland, Seattle, Austin, it's a fraction of what exists here in the Bay Area. During that time frame, okay, we've created one new home per 6.8 jobs created. And just to give you some context, a market is considered supply constrained when it's one new home per 3 jobs. So we're nearly double what you consider a supply constrained market, okay? I've talked to a lot of politicians in this space. I follow a lot of the advocacy groups for housing. The truth of the matter is, as long as the Bay Area continues to produce significant job growth, this economy is not going to slow down. Housing prices aren't going to get any better. If anything, an economic recession may return us back to normal balance, but it will not ever be in a supply plus market. We have decades to get ourselves out of this trend, okay? And I threw this article in here because it just kind of speaks to the typical rigmarole that we're in. It's a very unfortunate circumstance, but consider this. We're a supply-constrained market. It's a high barrier of entry supply-constrained market, okay? So any product that can get maybe increase density by 200%, who can offer rents, you know, significantly below the entry barrier of a studio, probably going to have some high demand. We'll talk about that in a second. No surprise here, the top 3 rent growth leaders, which this was RealPage's article in 2018, San Jose, Oakland, San Francisco, okay? And I believe as of last quarter, Oakland just surpassed San Jose for the most expensive rents. They've averaged over 5% appreciation year over year. So let's bring this back, okay? We're searching for change, we're responding to it and exploiting it as an opportunity. What is co-living? Okay, how is the co-living going to respond to these changes? Well, the first thing is, let me go back. Co-living is a very simple rent a bedroom model, okay? And it monetizes 2 things that already exist. The first one is kind of a hybrid student housing model. Consider this in high density urban areas. There's what we call the Craigslist model, where people are renting a 4 and 5 bedroom apartment. They're turning around, master leasing it from someone, and then renting out those rooms, okay? But the problem arises, people do this. Why do you do this? To get a lower rent, to pay less than you would if you rented a studio or 1 bedroom. You know, you may be paying $1,500 a month versus $2,000 to $2,500. That's a significant amount of money to people. But these models have created issues, okay? Who's going to clean the place? Who's going to handle the maintenance? Who's going to furnish it, right? Like, these are all inefficiencies in the marketplace, okay? Co-living as a model is monetizing that space. It's monetizing that existing marketplace, and it's making simpler and more turnkey, okay? The co-living operators that we're speaking with, they're focused on community activities, they're focused on networking events, and these are actual pictures from an operator, just to give you some context. They're focused on community, and people are excited about this because if you're a new college graduate moving to a city, you're plugged into, you know, 5, 6, 7, 8 people in this nicely furnished, brand new, you know, newly renovated space. with people who are of a similar backgrounds, right? And diversity of backgrounds. And we've heard incredible stories of people changing jobs through the networking opportunities through our operators. Our strategy is very specific. It's a value add strategy. So we're looking at, when we talk about adding 200+%, in density, we're taking existing vacant single family or try quads, as well as mixed use properties that are in need of high levels of capital infusion. We're using a live work code, or we're utilizing a co-living model to help increase density in these particular products, okay? We're focused on a construction time frame of 12 to 20 months. We want to bypass all the lengthy entitlement periods, the large barriers of entry that trip up large-scale development plays, particularly those who are looking to take capital gains and put them in an opportunity zone fund. And we want to do this in a very quick turnaround time. The locations that we're focused on, this is an overlay of an opportunity zone map. We are focused in other key parts of Oakland, like the Lake Merritt area, these areas up in here, Temescal. It's not just specifically opportunity zones, but we are seeking opportunities and opportunity zones for those who have capital gains. Mostly transit, retail-oriented corridors, all within a half a mile. We want assets with high walk and bike scores. And in particular, we're looking for census tracts, so zip codes within these MSAs that are seeing a growth in annual income as well as college educated, okay? That's the key for us. Another exciting thing about the Oakland-Berkeley market, and particularly the Oakland-Berkeley that I'll just mention very quickly, is Fundrise ranked the top opportunity zones in the country, and Oakland was #1, which we thought was very interesting and exciting. Of course, we were already in this before they came into it. But we think Oakland has massive upside. If you want to talk more about the Oakland market, I'd be happy to go into more detail as to why we're extremely bullish on that area. The finished product will average between 4,500 to 18,000 finished square feet. In the larger properties, we're focused on combining co-living with mixed use space for office or retail, depending on the area. Dictates whether we have ground floor retail or co-working office space. We've had a couple of deals that we came through that set up very well for this. One in particular, the 10th Street project that we went under contract on, that we've been working the owners for about 8 months. The average project size is about $2 to $15 million. Again, small balance, mid-market space, opportunities that we can capitalize very quickly, take low debt, larger chunks of equity in, refinance out. My background is energy efficiency and green building. Most of these properties are going to be master lease, so to speak. So we'll be paying for a lot of the utilities, which is exciting because we can then go in and put a lot of capital expenditures into reducing utility expense and see that return on investment. We also feel that this particular market, they're going to want to see those features. Those are selling features to them. And, for us, our team's combined experience in this space spans 20 plus years. So it's a no-brainer for us, but also exciting because we can have a high level of return on investment into those larger capital improvements for HVAC and water efficiency. Some good examples, if you see here, of other co-living projects from various other providers. The way it works is the tenant rents a room. You either have an in-suite bath or a shared bath. There's varying models of the rent premium you can get for an in-suite bath. Again, rents 15 to 20% below the cost of a studio or one bedroom. No subsidy, no compliance from federal housing agencies. We go in there when we pick that census tract or that area, that zip code, we find the neighborhood rents for a studio, we mark it down 15 to 20%. In return, this increased density that we're getting, that 150 to 200% added density, we're getting 20 to 30% net operating premiums versus traditional multifamily. It's truly staggering. The most recent project that Open Door, one of the operators that we're teamed up with, they finished a project in West Oakland and had over a 2,000 person wait list. What is the background? What is the marketplace that is co-living? I included a couple of these headlines in here because I think it's important to kind of look at this as a broad market of multifamily, right? And I shouldn't say a broad, it's a very specific market of multifamily, but a growing one. First and foremost, Europe, as you see here, a global co-living company in Europe raises over $1 billion. This has already been going on in Europe for quite some time. In very similar socioeconomic circumstances, high asset appreciation, high rents, stagnation, wage growth. So we're experiencing a very European model here in the United States in our cities. We're definitely feel as that this is going to continue to be a trend. And again, it's an established marketplace in the European market. As far as co-living startups, I think they just topped over 1 billion in venture capital money last year. Two of those going to Ollie and Common, Common is one of our potential operators for this market. It's very much at the inception, but there is a lot of money piling into this marketplace. I know that's very anecdotal, but I could go on and on and on and on about how much momentum this marketplace has right now, but how small it still exists to the broader context of the multifamily space. So where am I going with all this? We're on the early adoption stage. So while there may be a lot of perceived risk, hopefully what you've seen based on the demographic trends, this is a marketplace that's here to stay. We're continuing our raise for Opportunity Zone capital as well as non-Opportunity Zone capital. We're looking to raise up to $10 million, which we raised about a quarter of that in the spring of last year, of which we spent the last 6 months trying to place into deals. We're now focused more on the deal. We're always raising equity. We're syndicators. We're always raising money, but more focused on the deal side of the business because deals have been extremely hard to come by of late. We are mixing a very, very low debt model, 55 to 65% in debt. You can see our IRRs are fairly typical for the marketplace. We're experiencing a 4 to 6% cash on cash. In more instances, we're either doing that as a quarterly distribution or an 8% pref or 6% return hurdle. It really kind of varies. I know I'm being a little non-specific here, but because of how competitive deals are right now, it kind of varies on a deal basis, but we're really trying to hit a 6% return hurdle. That gives us a 730 split across the board. That's pretty standard. You're probably asking why such low debt. These are heavy value add plays, so we're looking at a long time frame before we have to go refinance. We're a little bit bearish on where the market's going in the next 12 to 18 months. We want to have low leverage, so if there's a drop in asset values, we're not having to do capital calls when we're refinancing out in 12 to 18 months. That's the simplest answer I can give you. For those looking to invest in the opportunity zones, the way that it works, and I won't go into too much detail here, but you have a capital gain, either being from the sale of stock or a piece of real estate. You invest that money into Opportunity Zone Fund, okay? And Revive is doing a single asset fund, okay? When they came out with the Opportunity Zone Fund, it's really a misnomer because it's not an open or closed fund model like you see in other real estate fund setups. You can do a single asset fund. All it is an extra LLC that you have to create that is audited by the not the SEC, by the Treasury Department for compliance with the Opportunity Zone guidelines. Okay, so they're auditing this LLC where you place your money into, saying, do you meet the Opportunity Zone requirements? Okay, we then go out and use that money to purchase an asset. That asset goes into an LLC, and Revive manages both the SVP or the purchasing and the purchasing entity. That's the way it works. It's the simplest way I can kind of give you. And that's, again, syndication model only. We are not an open or closed-ended fund. The benefit to you as an investor, if you're bringing a larger portion of capital, say 250 to 500,000 and above, there's less opportunity for you to be able to have to be pulled in with other investors because the capitalization of our projects are very low. So if you needed to exit, if you needed to get out and you're a larger capital contributor, then there's more flexibility for you than being into a fund where you're kind of stuck. Okay, and that was the other reason we are focused on these smaller assets, is because we think it gives more flexibility in an otherwise unflexible environment, being in a fund, and opportunity zones. Opportunity zones, you very much have to have a long-term point of view. The team. So I'm the acting general partner here at Revive. A quick thing, excerpt about my background. I have over 10 years construction related experience. I started my first business in 2010. I started as a subcontractor, again, focusing on energy efficiency and green building implementation in residential and light commercial buildings. I expanded that business across 3 different states, landed contracts with public utilities, nonprofits, new construction builders, custom, semi-custom, all the way down to tract home builders, and pulled the plug on that business in 2015 after making my first investment in 2013 in a multifamily. I wanted to parlay that experience and that knowledge into development, into syndication, and loved real estate investment and how it applies to the outside world. I've experienced in all facets of a transaction. I've done it all myself: the brokerage, property management. I've sourced every single one of my deals off market, sold them off market. I've yielded a 25 to 30% plus IRR. I now have over 7 figures in personal real estate assets and 6 figures in passive income. And that's starting with $75,000 in 2013 and growing and scaling that. This is my second entrepreneurial endeavor. I like to focus on social impact-based companies. I love the intersection between entrepreneurism and large socioeconomic problems, and kind of pairing those two. And always happy to talk more about how Revive really falls into that social theme. Our current architect and general contractor is a highly skilled, highly talented individual based in Oakland. He just opened up an office there off Telegraph Avenue in Oakland. Tyler Kobik. They've completed at least 2 to 3 projects now for Open Door. They're very tuned into the co-living model, as well as mitigating some of the downside risk of, hey, we've got this co-living building. What do we do if it has to be converted to multifamily? Though I don't think that's a concern. Tyler's done a fabulous job of designing these buildings if you ever wanted to convert them back to a traditional multifamily setup. And a lot of our design is focused not only around that, but obviously providing high quality furnishings and high quality amenities that are going to track that tenant base and retain that tenant base. Ben Probin is one of our many operators, probably the one that we have the most long-standing relationship and we feel most comfortable with, especially as it pertains to these smaller assets. We have operators who are looking for larger development plays. We are not a bread and butter developer. We're a value-add investor. Some of the larger operators are looking for larger scale facilities, 50 plus bedrooms. We think the co-living model really sticks and is sticky in the under 50 unit, where you can feel more communal and not just a bunch of people packed in. We think that that is the most dangerous aspect of the co-living model today and has the most market risk versus the traditional neighborhood, low density type asset with added density. We feel that that right now is the place that we want to be, and it's the portion of the marketplace that is the least served. And for a lot of different reasons, which I won't get into, but we're very bullish on that marketplace, and it's where we really want to start and grow our portfolio and try to find a model that's truly scalable. I really appreciate your time. Thanks so much for sticking with me. If you have any more questions, feel free to call me, 415-805-8933. That's 415-805-8933. That is my direct line. If I don't pick up, shoot me a text. You can always inquire through our website. There should be a contact form. If not, very shortly below this video within the general homepage. We look forward to your questions and look forward to the opportunity to speak with you. And thanks so much.